Hey guys, so I started this channel about 2 years ago with the goal of educating people to make better decisions when investing in stocks. Since then, I've been making a lot of videos about stock investing strategies like valuation, macro indicators, reading the Federal Reserve actions, and investment mindsets. Now, I understand that a lot of you are new to the channel, and very recently I've been getting a lot of questions like, how can I become a better stock investor? How can I read the market better? What indicators do I have to monitor? Now, while my previous videos cover everything related to those questions, I do understand that my videos are now quite scattered in the library, which makes it hard for you to find the ones which are strictly relevant to the fundamentals of stock investing. So, I wanted to make this compilation video, which includes all the basic theories about stock investing. For each of the video, I'll include a short commentary in between so that you get an idea of why I made such video. Now, because this video is a compilation of my past videos, the quality of the videos may not be good for the older videos, but I hope you can bear with me. I can assure you that if you watch this video thoroughly a few times, you'll pretty much master all the basic skill sets you need to have to become a better investor. Okay, let's get to it. Now, the first video is a course on price to earnings ratio. As you may all know, this is probably the most important valuation metric which I refer to in my market update videos. Hopefully, through this video, you can get a better understanding about the most basic methodology when valuing stocks. Okay, here we go. Today, I wanted to deep dive into a stock pricing and valuation metric. The most commonly used valuation metric in the stock market from an equity investor's perspective is the price to earnings ratio, which is generally noted as the PE ratio. Now, I've been monitoring a lot of videos on YouTube, and they spend 10 or 20 minutes talking about how PE ratio is important and that you need to focus on this valuation metric to succeed, and also the way to calculate the PE ratio, which literally takes like 2 seconds to learn it yourself. It really amuses me how all bullshit YouTubers talk about this simple metric on and on, wasting everyone's time, and what they're saying can actually be explained in 2 seconds. Today, I want to cover this concept of price to earnings, but going further from here, how to actually understand this number and how you should apply it yourself when you're investing. Okay, now, what is price to earnings ratio? It is a very simple concept. All you need to do is divide a company's market cap by its net income. Assuming that company A's market cap is currently at 100 billion and its net income is at 10 billion, the company's price to earnings ratio is 10x. Simple, right? Now, this is where all YouTubers stop explaining about the concept itself and just go on and on about the importance of this metric and how you should be looking at it all the time. Now, why don't we just deep dive into it? I want to break down this topic into 5 topics to help you get a better idea of what this metric actually means. Number 1, why is price to earnings ratio actually important? So price to earnings ratio shows how long of a time a company takes for it to make money up to the total value of the shares you paid to purchase for it. For example, in the example I gave you just now, company A's market cap was at around 100 billion and its net income was at 10 billion, implying a price to earnings ratio of 10 times. What this means is that starting from today, this company A will take 10 years for it to make the money you paid to purchase the company. So assuming you purchased 10 shares out of a million shares, total shares of the company A, it would mean that you're owning 0.001% of the company's stake. If you purchase those shares when the company was at a market cap of 100 billion, as a shareholder, you're also potentially gaining the right on 0.001% of the 10 billion net income the company is generating, which you can potentially benefit through dividends or share buybacks in the future. So basically, the basic concept is how long of a time it takes for you to get your invested money back from the company down the road. Depending on the price to earnings ratio, it may suggest that it may take 10 years or 5 years or 20 years. Now, based on what I told you now, low number looks good, right? Getting your money back in 5 years is definitely better than getting it back in 10 years. Well, that's not really the case. So let's move on to the next topic. Number 2, understanding price to earnings ratio from financial projections perspective. Now, we talked about the overall concept of price to earnings ratio. Right now, you might think that a 5 times price to earnings ratio company is better to invest than a 10 times price to earnings ratio company. Well, let's try to prove that that is not the case. Let's say that you have company A and company B. Company A and company B both currently have market cap of 10 billion, while company A has net income of 1 billion, while company B has net income of 500 million. This means that company A is trading at 10 times price to earnings ratio, while company B is trading at 20 times price to earnings ratio. Does company A look better to invest? Well, let's think about that. let's assume that in 2024, Company A and Company B recorded net income of 1 billion and 500 million. But in 2025, Company A again recorded 1 billion and Company B suddenly also recorded 1 billion. Then in 2026, Company A's net income still stays at 1 billion, but Company B's net income increased to 2 billion. In the next 2 years as well, let's assume that Company A's net income stays at 1 billion, but Company B's net income increased to 3 billion and 4 billion. Now in aggregate, over the 5-year time frame, Company A generated total net income of 5 billion, while Company B generated total net income of 10.5 billion. While it might seem like you're investing in an overvalued stock at the time of the investment, looking at this result, investing in Company B turned out to be a better choice. This is why a company's future prospect is much more important than its historical performance when you're investing in a stock. So let's move on to the next topic. Number 3. Understanding price to earnings ratio from a regression analysis perspective is important. So based on what I told you so far, you'll now understand that low PE is not always a good thing. So now let's try to deep dive further into how we can understand the price earnings ratio better relative to its earnings growth. So now you understand that the future net income is crucial when buying a stock. So to get an even better idea of whether you're making the right purchase, you can do what is called a regression analysis. A regression analysis is something you do to find out how much of a close relationship two metrics would have with each other. Generally, the formula is a linear formula which is noted as y equals A plus XB. If you have a fair number of set of data, you can automatically generate the chart and the equation in the Excel. So this is the Excel spreadsheet. And here I have 10 companies with different price to earnings and next 5 years EPS growth. There are 2 things to consider here. When you're running this regression, number 1, please make sure that you're comparing against the companies within the same industry. And number 2, make sure that you have around 10 companies to make the regression analysis more meaningful. Now, I'm not going to go into the details of the formula, given the goal here is really to be practical rather than being academical. So with the data that you have, you can create a scatter chart in the Excel like this. And if you press the plus icon next to the chart, you can also add a trend line and a regression formula. Now, based on the trend line, you can get a sense of how steep of a relationship your set of data has with each other. Also, if you press the plus button again, you can also insert a thing called R squared. Now, what is R squared? R squared shows how much of a correlation the 2 sets of data you laid out have against with each other. A higher R squared means that the correlation between the PE ratio and the earnings growth are highly correlated. So you can confirm that for the industry which you picked, a higher earnings growth leads to a higher PE ratio. The reverse would work for the vice versa. Now, I would suggest that you only put a lot of confidence on your PE ratio and the correlation with its net income growth projections only if this R squared is above 0.8. R squared is between the range of 0 and 1, and a 0.8 would act as a strong basis for you to believe that the price to earnings ratio of the stock you picked is trading either high or low because of its earnings growth is either high or low. Number 4, always look at forward price to earnings ratio. Now, when I say forward price to earnings ratio, what I mean is a forward-looking price to earnings ratio. For example, right now it's December 2024, so generally you can find actual reported net income up to the 3rd quarter of 2024, which is September 2024. You might add the last 4 quarters of net income to derive your price to earnings ratio, but oftentimes this leads to a mistake. This is because companies have a lot of one-off items in the reported net income, such as one-off taxes, one-off expenses, and etc. And therefore, you would want to look at either 2024 full-year net income projections as the basis of your price-to-earnings ratio calculation, or if you're approaching an year-end, like now, you may even want to use 2025 net income to derive your price-to-earnings ratio. Also, given all equity investors are forward-looking, in other words, they care about what will happen in the future, not the past, it makes even more sense for you to focus on forward PE ratio. Number 5, don't only rely on price to earnings ratio. Now, price to earnings ratios can be very volatile. A stock can be trading at a very high or low level because of a one-off event. For example, a political push, geopolitical tension, natural disasters like COVID-19, sudden inflow of capital from market participants, and etc. I suggest you always make your own hard, cold projections and follow your instinct when purchasing a stock. Now let's summarize the key considerations of price to earnings ratio. Number 1, price to earnings ratio is important because it shows how long of a time a company takes for it to make money up to the total value of the shares you paid to purchase it. Number 2, a company's net income forecast is what determines the price to earnings ratio. If the projections are high, A price-to-earnings ratio may be trading at a high level and vice versa. Number 3, you should always verify the relationship with the price-to-earnings ratio and net income growth of your company, which you want to invest, using regression analysis and R-squared analysis using comparable companies. Number 4, you should always look at forward price-to-earnings ratio. And number 5, don't only rely on price-to-earnings ratio, as it may be impacted by one-off events which may fade away quite quickly. Now that's the end of my lecture on price-to-earnings ratio. I'll be back with more videos soon. Okay, so as a follow-up to the price-to-earnings ratio video, the second video is a course on EV/EBITDA valuation multiple. Now, while price-to-earnings ratio is a valuation metric strictly for the equity holders, EV/EBITDA multiple covers the debt structure of the company as well, which would give us a better idea about the company's cash flow from its pure operations perspective. Okay, here we go. Okay, so some of you may have seen my video titled PE ratio really explained. In the video, I explained why PE ratio is important, how to calculate it, but expanding from there, also talked about the implications this metric has, including the importance of future prospect of the earnings. However, in my investment strategy related videos, a lot of you may have realized that I generally look at EV/EBITDA multiple just as much as PE ratio, and sometimes even prefer to just look at EV/EBITDA multiple rather than a PE ratio. Today, I wanted to explain to you guys why I look at this multiple closely and when this multiple can be meaningful when valuing the company. Now guys, please watch this video very carefully. I know a lot of retail investors just focus on PE ratio because it's the most commonly used valuation metric among the public, but understanding EV/EBITDA multiple properly will really enhance your understanding about valuation and really up your game when it comes to investing. Now, just like PE ratio, I noticed that there are a lot of videos on YouTube which explains how to calculate EV/EBITDA multiple, but there are not that many videos which actually explains why this metric is important. Today, I'll break down this topic into 3 subtopics, including number 1, calculating the multiple, number 2, what this multiple actually means, and number 3, when we should be focusing on this multiple. Now, as always, I'll try to be as practical as possible, so I'll avoid going into too much technical and academic details around this topic. Okay, so on the first topic, calculating the multiple. Just like PE ratio, it's a very simple calculation, though it requires a bit more manual labor. In order to calculate an EV/EBITDA multiple, you need to calculate EV, which is enterprise value, and EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Now, first on the EV. Basically, EV is calculated with the following formula. Market cap plus total debt plus preferred stock, if any, plus minority interest, if any, minus cash and cash equivalents. Now, market cap is straightforward. It's just the market cap you see on Google or any website. Let's assume there's a company with $10 billion of market cap, so the company's market cap is $10 billion. Now, for total debt, you need to go into the company's financial statements, go to the balance sheet section, and identify line items that says long-term debt and short-term debt, and add the two. Basically, for total debt, you want to identify interest-bearing debt only and just take into account of these items. Let's assume that the company's total debt is $2.9 billion. Now, one additional thing to note here is that after the global accounting standard changed to a thing called an IFRS 16, they started booking lease agreements as long-term liabilities, which gets amortized in the income statement, which is effectively treating rent like an interest expense. Now, generally, these are quite small in size, so no need to be confused by it, but just note that if you see a line item which says long-term operating lease liabilities, just add that item as well. Now, in our case, let's assume that the lease liabilities are $100 million. So in total, we have $3 billion of total debt. Now, generally, if we do this, we would have covered most of the interest-bearing debt. Very rarely, companies will show separate line items for other non-traditional interest-bearing debt, like convertible bonds, convertible shares with redeemable features, revolver facilities, and etc. If you see those items, you can just add them as well, as long as they're interest-bearing. But most of the times, those should be captured under either long-term debt and short-term debt as well. Okay, now moving on to pref shares. Now, generally, the companies which we look at will rarely have any pref shares issued. However, if there are pref shares issued, there will be two cases. The pref shares may be listed or may not be listed. Now, if you spot any listed pref shares, just add the pref shares market cap on top of the EV. If you see unlisted shares, we will need to conduct a separate valuation on the shares. However, given the size is generally very small, I would just add their book value on top of the EV. The book value of the pref shares can be found in a company's balance sheet under a line item called preferred stock. For our case, let's assume that this company has 0 pref shares issued. Okay, now moving on to minority interest. Now, like pref shares, generally the companies which we look at will rarely have a sizable minority stake. A minority stake is shown on a company's financial statement if a company controls a subsidiary but does not own 100% stake. For example, if the company owns 80% stake in a subsidiary, the value of the remaining 20% stake will be shown as a minority interest in the income statement and the balance sheet, and the company's market cap will assume that the 20% is not something which is attributable to the shareholders of the company, so it will not take into account of the value. The reason we include minority stake in the EV calculation is because we want to get a full picture of the company as a whole, including the subsidiaries which the company controls. For our case, let's also assume that this company has 0 minority stake. Okay, now moving on to cash. All you need to do for this is just take the line item labeled cash and cash equivalents in the balance sheet of the company. It's generally the first line item that shows in the balance sheet. So you can just grab that number. For our case, let's assume this company has $1 billion of cash. Okay, so to sum up, the company's market cap is $10 billion, its total debt is $3 billion, and its total cash is $1 billion. Therefore, the company's EV is $12 billion. Okay, let's move to EBITDA. Now, for EBITDA, you just need to take the number that is called operating income in the income statement and add depreciation and amortization. Operating income is generally in the middle of an income statement. Let's assume that our company has operating income of $1 billion. Also, for D&A, just go to the company's cash flow statement and take the number next to the line item, depreciation and amortization. For our company, let's assume the company has $200 million of D&A. Now, if we add those two together, we get $1.2 billion as the company's EBITDA. Okay, so to calculate EV over EBITDA, we can see that the company has EV of $12 billion and EBITDA of $1.2 billion, which results in EV over EBITDA of 10 times. Okay, so that was straightforward. By the way, if you don't want to calculate the EV EBITDA yourself, you can just get those numbers on Yahoo Finance or any other website. These multiples are generally easily available. Now, let's move on to the more important topics. Number 2. What this multiple actually means. To give you a simple explanation, EV/EBITDA multiple takes into account of debt and equity of a company, which allows the investor to value the company regardless of the capital structure. Now, to help you understand this better, let me try to give you an example using a house. Okay, let's assume there's a house. Let's assume this house is worth $1 million and has $500,000 of mortgage. Let's also assume that the house yields $50,000 a year in gross rent, but after interest on the mortgages, taxes, and etc., the net rent is $20,000 a year. Now, in this example, if you are trying to buy this house and the bank which provided the mortgage comes to you and says that they'll roll over the debt for you so that you can just keep the mortgage, basically you only have to pay $500,000 to purchase this house. Now, this $500,000 is the equity value of the house. Equity value is basically the amount of money you have to pay to purchase an asset. Therefore, the more debt an asset has, the less equity you have to pay. So, equity value of this house is $500,000. However, when you tell your family and friends that you bought a house and they ask you what the price of the house was, you generally won't say that the house is worth $500,000. You'll rather say that you bought a house which is worth $1 million. Now, this $1 million is equivalent to the EV. So basically, what I'm trying to say is that EV represents the value of a company regardless of how much debt or cash the asset has at the current moment. Okay, so in a similar context, $50,000 of gross rent you get from the house is equivalent to the EBITDA, given that it's what you get before you pay any interest or taxes on it. Also, $20,000 of net rent you get from the house is equivalent to the net income, given that it has already subtracted all the line items, including interest expense and taxes. Okay, so if we value this house has an EV/EBITDA of 20 times and price to earnings ratio of 25 times. Okay, so hopefully this example gave you a better idea of what EV/EBITDA means. Now, in this example, I didn't take into account of the depreciation and amortization, given it may complicate things in understanding the basic concept. However, D&A is a simple metric which basically deducts any value from an asset. For example, if you bought a new laptop for $2,000, after 10 years, if you try to sell the laptop on eBay, no one is going to pay this laptop for $2,000, right? You'll need to significantly lower the price of the laptop to sell it. Now, before you actually sell the laptop, you're not paying any cash, just because the value of the laptop is decreasing. But the value of the laptop is decreasing every day. Now, this is called depreciation. When you calculate EBITDA, you basically need to add this depreciation or amortization on assets to get a better sense of how much cash the company is generating every year. Operating income already deducts a certain part of the depreciation, so it is not a good metric to assess the cash generating ability of the company. Okay, now let's move on to the third topic on when we should be focusing on this multiple. Now, EV/EBITDA multiple can be used for any companies with the exception of some very niche industries like banks and insurance companies. However, let's try to understand when this multiple can really be used more meaningfully when we are investing in public markets. Let's assume there's a company A. Let's say that this company's market cap is $5 billion and its operating income is $500 million. Let's also assume that this company has zero debt and also has almost no cash. Also, let's assume that this company has almost no hard assets, so there's really nothing being amortized or depreciated. Basically, this is a company which has a very stable balance sheet with no debt and is super asset light. For this company, basically, its market cap is almost equivalent, if not exactly the same, to the EV, and its operating income is almost the same as EBITDA. In this case, EV/EBITDA is not really useful. Basically, its PE ratio and EV/EBITDA multiple would pretty much be the same, with some difference taking into account of the taxes. However, let's assume there's company B. Let's say that this company's market cap is $2 billion, but has operating income of negative $100 million and net income of negative $200 million. Now, if we try to look at this company based on PE ratio, we'll have a negative figure. And if our investment principle is to invest in low PE ratio companies, we may just ignore this company as a whole. However, in some cases, that may not be a smart decision to make. Let's assume that we looked at company B's revenue growth and this company is growing at around 30% per annum. Now, that's a very high growth, and if a company is recording that strong growth, it's a company which is worth taking a look at. We would need to look at the company's capital structure, and looking at its balance sheet, we realize that the company has around $2 billion of debt. Now, assuming the interest on the debt is around 5%, their interest would be around $100 million. Now, here, looking at their operating income and net income, given the difference between the two is around $100 million, we can safely assume that the additional $100 million of loss from their operating income is almost entirely coming from their interest expense. Okay, so we now figured out where the huge non-operating loss is coming from. Now, what's really important here is to figure out where this $2 billion of debt is being used and whether this debt is being used efficiently. The situation we want to avoid is this company using most of the loans to pay down their interest on the existing debt, which is not a healthy capital structure. So you look at the company's assets and realize that the reason this company has been taking a lot of debt is to build factories. Now, this company built the factory only about a year ago, and this $2 billion of debt was almost entirely used to build a new factory. So at this point, you can make a few conclusions. Number one, the debt that they have is being used efficiently as they built a new factory with the loan. And number two, the new factory is actually contributing to their operations considering their revenue is growing at 30% per annum. Number three, because their factory is relatively new, they had to spend a lot of upfront cost with a lot of new hirings and utility cost, which is why their operating income is currently negative. And number four, if their revenue continues to grow at this pace with the new factory they built, their operating income would also continue to increase. Okay, up to this point, you can basically conclude that this company is a good company with good working strategy, with a factory which was built with the right purpose. Now, the only thing you need to check here is whether this company can actually pay the interest without much trouble. Now, this is when you can use the EBITDA concept. Given EBITDA adds back non-cash expenses, including depreciation and amortization, is a metric which can better represent the cash-generating ability of a company. You look at the company's depreciation and amortization and realize that every year, this company is booking around $200 million of D&A with the new factory, as well as the existing factory which they built around 10 years ago. Now, if you add this $200 million on the negative $100 million of operating income, you have an EBITDA of $100 million. Now, given the company's annual interest expense is $100 million, you can assume that the company can most likely pay off their interest with the annual cash that they're generating. So you can assume that this company will not go bankrupt or whatever because of their debt. One caveat here is that when the market has a very high liquidity environment with low interest rate and quantitative easing, you can be more aggressive with your assumptions. Even if a company's EBITDA is not enough to pay their interest, as long as they're recording a healthy growth, they should be able to refinance their debt as money becomes extremely cheap. Okay, but for this company B, they have a decent capital structure which allows them to pay their interest on time. Okay, so now you have a good ground to value this company on an EV/EBITDA basis, given you can safely assume that this company will turn around anytime soon. Now, the company's market cap was $2 billion and had $2 billion of debt. Assuming the company has minimal cash, its EV is $4 billion and its EBITDA is $100 million, which implies an EV/EBITDA of 40 times. Now, 40 times EV/EBITDA sounds very high. However, based on the 30% growth rate which the company is recording, you can try to extrapolate the company's future financials and see what the EV/EBITDA will be in the next 3 to 5 years. In the next 3 to 5 years, assuming that the company pays off around $1 billion of debt and its EBITDA triples to around $300 million, basically on today's market cap, its EV will be $3 billion while its EBITDA is $300 million, making its EV/EBITDA 10 times. Now, based on its future expected multiple, you should be able to make a better decision on whether you should invest in this company. Okay, so to summarize, this is why EV/EBITDA can be helpful when investing. Number one, even if a company is going through a huge loss in its net income, if you assess the company's capital structure and value the company on an EV/EBITDA basis, you might be able to spot good investment opportunities better. Number two, EV/EBITDA multiple allows you to get a sense of true value of the company regardless of their capital structures. For example, companies like Tesla also experienced a huge net income loss for almost a decade before turning positive. If you paid attention to this valuation metric, you may have spotted opportunities earlier on. Number three, if you monitor EV/EBITDA multiple of a company, it'll force you to pay attention to the capital structure and fundamental business of the company. Calculating EV/EBITDA yourself and building your own thesis around it requires a lot more work than just grabbing the market cap and net income and making a single division, which is not really helpful in getting to know the company better. Number four, if a company is engaged in manufacturing or heavy asset business, this multiple is extremely helpful in understanding how the future of the company will be versus just looking at a PE ratio multiple. Okay, so on the last topic of how we should value companies based on this multiple, please refer to my PE ratio video for further details. Basically, the way you would value companies based on this metric would be very similar to a PE ratio. The only difference would be this. For companies which are not recording a high growth, let's say less than 10% revenue growth, please don't use forward EV/EBITDA to compare the trading multiple versus its peers. EV/EBITDA takes into account of the debt structure of the company, which is a status quo position of the company's financials. So for a low growth company, it makes more sense to compare against the peers using a historical EV/EBITDA. However, for high growth companies, I would suggest you try to focus more on comparing the multiple against the peers using a forward EV/EBITDA multiple. This is a debatable point. However, after the excessive quantitative easing which the Federal Reserve started adopting, companies started to adopt aggressive capital structures in return for growth, which forces us to look at this multiple on a forward basis as well. Basically, a lot of companies are willing to expand rapidly in return for high leverage, so we sometimes need to focus on the future even for this multiple. Okay, so with that, I went through all the important factors when looking at an EV/EBITDA multiple. Please keep in mind that understanding this valuation metric is very important for you to better understand companies from a financial position perspective. So please try to familiarize yourself with this metric when making investment decisions. I hope you enjoyed the video, and I'll be back with more videos very soon. Okay, now that we have covered the two most important valuation metrics, we now move over to the macro side of things. The first video is, of course, on the Federal Reserve and the key metrics we need to monitor to get a sense of the overall liquidity situation of the market. Okay, here we go. Hey guys. Now I mentioned in my previous video clips, including shorting the market, investing in NIO, and Plug Power, a lot of my investment thesis revolves around how the Federal Reserve shifts its monetary policies. I want to deep dive into this topic and give you an idea of how you can also make a lot of money by just looking at Federal Reserve's policies. To explain this topic, we need to familiarize ourselves with two metrics. Number one, the Federal Reserve policy rate. As you may be aware, Fed policy rate is the interest rate set by the governors of the Fed and the FOMC. They decide on the changes of the rate after recommendations submitted by the Regional Federal Reserve. Now this Fed policy rate is important given that it hugely impacts the borrowing rate of money. All financial institutions and companies would price their bonds, loans, based on this rate. And even when you're getting a mortgage loan, this rate will impact your life. Simply put, this rate determines how cheap the money is. So if the Federal Reserve policy rate is low, it means money is cheap, given you don't have to pay much for borrowing money. And if it is high, it means money is expensive, given you'll be charged with a higher interest rate. As you can see in the chart, sometimes the policy rate goes up and sometimes it goes down. Generally, when the economy is doing very good or inflation is high, the Fed will increase the policy rate to cool down the economy or inflation. And when the economy is doing bad, they would decrease the interest rate to bolster the economy by providing more liquidity in the market. Some examples of the interest rate going up is in 2008 when Lehman crash happened, and 2020, when the COVID-19 happened, which forced a lot of companies to shut down their business. Examples of the interest rate going up is in 2004, when the economy was doing very well, led by the lucrative financial system, and in 2022, when the inflation was so high that the Federal Reserve had to intervene to cool down the purchasing power of consumers. The next metric we need to look at is the Federal Reserve balance sheet. Federal Reserve balance sheet represents how much assets the Fed has in their balance sheet, which are generally the US Treasury bonds and mortgage-backed securities. When the Fed goes out to the market and spreads money around to provide liquidity, they would generally do that by purchasing bonds in exchange for cash to the buyers in the market. So as a result, the Fed will get more bonds in their balance sheet and the market will be provided with the cash. In that case, the Federal Reserve's balance sheet would increase. And when the Fed wants to decrease the money supply in the market, they would either sell the bonds and assets or just let it mature and not invest the money received in return for the matured bonds. In that case, Federal Reserve's balance sheet would decrease and the market would be left with less cash. As you can see in the chart, sometimes the balance sheet goes up and sometimes it goes down. The Fed increases balance sheet to provide more liquidity in the market. Some examples are in 2008 when the Lehman crash happened, and in 2020 when COVID-19 happened. It can also decrease its balance sheet to cool down the economy. Some examples are in 2018 and 2019 when the Fed felt there's too much money in the market from the quantitative easing from the Lehman crash, and 2022 to today, given the Fed wanted to remove some liquidity in the market post multiple quantitative easing during the COVID-19 period. Now, to summarize, if the Fed policy rate is low, it means more liquidity. If the Fed policy rate is high, it means less liquidity. If the Fed balance sheet is increasing, it means more liquidity. If the Fed balance sheet is decreasing, it means less liquidity. So, in short, the most liquid period for the market is when the interest rate is low and Fed balance sheet is increasing. And the least liquid period for the market is when the interest rate is high and Fed balance sheet is decreasing. Now, if you put that into a 2x2 matrix, you have a chart which looks like this. You have 4 quadrants with the 2 matrix, and depending on where we are with the Federal Reserve policies, our strategy should also change. Now, starting from the section A, this is the time when you need to only focus on revenue growth. The reason interest rate is low and balance sheet is increasing is because the Fed is expecting the economy to slow down. So they're providing tons of liquidity into the market. In this case, all the liquidity that is provided in the world will be hunting for growth, given growth becomes extremely scarce. Also, given there's so much liquidity and money is cheap, you don't even need to worry about a company's profitability. They will survive somehow using debt and leverage. This strategy works during times like this. This is why I decided to invest in NIO and Plug Power in 2020. They were recording phenomenal growth despite having no profitability. Now, skipping to Section D, this period is when the growth is not as valued as Section A, given there's so little liquidity in the market. In times like this, you will need to focus on companies with high profitability and margins. Look at price to earnings ratio and pick the stocks that are showing high margins with low valuation. This is when traditional sectors like pharmaceuticals, food and beverage, manufacturing gets a lot of attention. Now, Section B and C are a bit tricky. This section also applies to the world we're living in right now, given interest rate is going lower, but the Federal Reserve balance sheet is shrinking. Like we see in Section C, in a period like this, the market would look for companies which has both the growth and the profitability. This is when there's some liquidity in the market, but not enough to focus only on growth. So people will look for a company which has both. Now, this is why the tech stocks with both growth and profitability, like Nvidia, is getting a lot of attention. Stocks which are worth investing become so scarce that the market would really focus on few stocks that meets the criteria. Now, that was a quick summary of how you should change your investment strategies depending on the Federal Reserve policy changes. Of course, there are a lot of other factors which you need to consider, but knowing what I just told you now will help you tremendously in making the most lucrative decisions when the right timing comes. Okay, now that we have covered the Federal Reserve, we now move on to the broader macro indicators. In order to understand how and when the Federal Reserve takes certain actions, we need to monitor the key macro indicators like unemployment rate, inflation, and economic activities index to preemptively make decisions. Okay, here we go. Okay, so a lot of you are following my channel to hear my analysis on the latest macro trend and the investment strategies in accordance with the macro data. During the past months, I have been uploading macro analysis videos which hopefully would have helped you to make better investment decisions. Now, through those videos, I showed you how I analyzed the latest macro trend and used them to our advantage to predict how the Federal Reserve may take actions, and further, how the market will react in accordance with the Fed's expected actions. I also consistently emphasize that familiarizing yourself with the macro trend is the most important factor when it comes to investing in the modern economic world, especially after the 2008 financial crisis. I'm sure you guys listen to my videos carefully and try to learn how you can interpret the macro data. Now, while I've been uploading market update videos periodically, a lot of you guys said in the comment section that you guys would like to get a very basic overview on how to read the macro data. Now, this is a very broad topic, and it took me some time to think how to do this in the most efficient way possible. The reason it took me a lot of thoughts is due to the following. Number one, every macro data are generally not independent and somewhat correlated with each other. What this means is that we can't just look at each macro data one by one, but we need to look at them all together to get a holistic picture of the current status of the economy. Number two, there are so many data that is thrown to the market. It is our job to pick and choose which data we'll be focusing on and use them to our advantage. Number three, data can have different versions of numbers. For example, key data like unemployment rate or the CPI will have its officially announced numbers, but some other institutions may develop their own methodology of coming up with their own number for the same metric. Now, with all those considerations, I decided to make a video which is very basic for beginners with the following caveats. Number one, I'll focus on explaining the key data one by one. Now, given this is a very basic introductory video, I'll not take into account of every implications a data may have, but only focus on that single number and what implications that single number may have on the market. Number two, I'll focus on 10 key data which I focus on. Now, there are millions of data which we can monitor, but realistically, we can't monitor all of them. However, I can assure you that if you monitor the 10 key data, which I'll explain, you'll be covering around 80 to 90% of the macro economy. Number 3, I'll focus on official data only. Now, the reason I only monitor the official data is because the whole reason we do macro analysis is to predict the Federal Reserve's actions. Now, the Federal Reserve monitors the official data, so while we may monitor other versions of the data, it won't be too helpful in forming our view on the Fed's actions. Therefore, I'll only focus on the official data. Number 4, now, in order to leverage the macro data to your advantage when investing, please refer to my stock investing strategy for beginners video. What I'll be explaining today is just basic concepts of macro indicators and how those indicators impact the Federal Reserve's decisions. If you actually want to use them to your advantage when investing, please refer to my other video for more details. Now, having that said, before we begin, all the macro data can be found on key economic news websites such as Yahoo Finance or investing.com. Make sure you turn on the alerts for economic data from those websites so that you can get the latest data real time. Okay, let's begin. Now, when we look at the economy, the key data which represents the output of all the activities that happen in the world comes down to the GDP. You may remember that I explained multiple times that a GDP is composed of 4 components, which are C, G, I, and X. Now, C stands for consumer spending, G stands for government spending, I stands for investments, and X stands for net exports. Now, in recent years, the GDP growth was somewhat subdued, with the growth being in the range of somewhere between 2% to 3%. However, while the GDP growth is the outcome of all the activities that happen in a country, GDP growth itself doesn't really mean much, as it's just a resulting number. What really matters is the data that is behind the GDP growth, which are released on a weekly or monthly basis. Now, for those data, if I had to group them in a few categories, I would categorize them into number 1, job market related data, number 2, inflation related data, and number 3, economic activities related data. Now, the reason I group the data into these 3 categories is because these 3 topics are what the Federal Reserve monitors closely. Basically, the Fed has its own moving targets for each of these categories of data, and by forming your view on each of these components, you'll be in a pretty good position to predict what actions the Federal Reserve will take. Okay, now, behind each of the categories, there are 10 macro data which I closely monitor. First, on the job market, the data which I monitor is number 1, unemployment rate, number 2, initial jobless claims, and number 3, non-farm payrolls. Next, on inflation, the data which I monitor is number 1, the year-on-year CPI, number 2, the year-on-year core CPI, and number 3, the month-over-month PPI. Next, on the economic activities, the data which I monitor is number 1, the ISM manufacturing PMI, number 2, the ISM non-manufacturing PMI, number 3, Chicago PMI, and number 4, consumer confidence index. Okay, so as I said previously, I believe that if you monitor these 10 macro data periodically, you'll most likely cover around 80 to 90% of economic activities. To help you understand the implications of each data better, let me go into the data one by one to explain what these mean. Okay, first on the unemployment rate. Now, this is a very straightforward concept. Basically, unemployment rate measures the percentage of total unemployed workers who are actively seeking for a job versus the entire workforce. Now, generally, the unemployment rate measures how active the job market is, which is a fundamental measurement of how the economy is doing. If the unemployment rate is low, this would mean that companies are generally doing well with their products being sold a lot to their consumers, which would provide the companies more room to hire more people. If the unemployment rate is high, it would be the vice versa. Now, the Federal Reserve and the government generally has its own target unemployment rate. In recent years, the Federal Reserve and the government generally views the economy to be fully employed if the unemployment rate is as low as 4%. Now, this 4% number is subjective, and there's really no strong rationale or backup to the number. But all we need to remember is that the Fed is focusing on this 4% number. Now, with this 4% number as the threshold, the market and the Fed generally views the unemployment rate like this. Over 5.5% unemployment rate means a weak economy. 4 to 5.5% unemployment rate means an okay economy, and under 4% unemployment rate means a strong economy. Now, for your information, there's really no hard rules or formula behind these numbers. Apart from the 4% target, I'm setting the high, normal, and the low numbers based on my interpretation of how the Fed and the government generally reacts to the numbers. So you can have your own version of the numbers, but just think of my numbers as a general guidance. Okay, now, when the unemployment rate is high or low, the Federal Reserve takes actions accordingly. As I said previously, while all economic data are correlated and impacts one another, everything else being equal, the Federal Reserve will take expansionary actions when the unemployment rate is high and take contractionary measures when the unemployment rate is low. Now, for your reference, when I say expansionary, what I mean is that the Fed will either cut the rates or conduct a QE. When I say contractionary, what I mean is that the Fed will either increase the rates or conduct a quantitative tapering. Okay, now the reason the Fed would take expansionary actions if the unemployment rate is high is because if the unemployment rate is high, this means that the economy is weak and corporates are performing bad. The Fed wants to bring the unemployment rate to their target level of 4%, so they would reduce the company's financial burdens by lowering the interest rate. Now, when the unemployment rate is low, the Fed would think that the economy is overheated and it may trigger an inflation. In this case, the Fed would try to cool down the economy by increasing the interest rate. Okay, so that was straightforward. Okay, now moving on to the initial jobless claims. Now, initial jobless claims represent the number of people who filed for unemployment insurance for the first time during the past week. This is a leading indicator of the unemployment rate and is released on a weekly basis. A higher number means that more people are losing jobs, and lower number means that less people are losing jobs. Now, while the Fed does not have a hard target for this data as well, based on the recent trend, you can generally assume that any number within the range of 250 to 350,000 to be a normal state. Anything above 350,000 would be considered high, and anything below 250,000 is considered low. Now, in recent months, this number was consistently below 250,000, and this is why the Fed was assuming that the job market is too hot to decrease the interest rate, although they changed their stance at the Jackson Hole. Now, just like the unemployment rate, the Federal Reserve's potential actions are the same. If more people are losing jobs, the Fed's actions will be expansionary, and if less people are losing jobs, the Fed's actions will be contractionary. Now, one thing I'll note at this point is that, as proven by the recent actions of the Fed, a single data, such as unemployment rate or initial jobless claims, does not determine the Fed's actions. Even if the job market is overheated, depending on political situations and other factors in the economy, the Fed may make different decisions taking into account of other circumstances. Please remember this. A single data does not determine the Fed's actions, but you need to take a holistic view. I'm only explaining the basic concepts of each data. Okay, now moving on to non-farm payrolls. Now, the reason this data is key is because this data represents the employment situation of the bulk of the entire industry in the US. The reason we exclude farming industry is because, number one, farming industry is highly cyclical, so it may distort the data. And number two, the farming industry is only a small share of the total employment, which has a minimal impact on the overall economy. Now, having that said, while there's no hard rule on this one as well, you can generally consider that any number between 50,000 to 250,000 as a normal state. Anything above 250,000 would be considered high, representing a strong job market, and anything below 50,000 would be considered low, indicating a weak job market. Now, in this case, the Federal Reserve's actions would be the other way around. If the number is high, the Fed would think that the economy is strong and would take contractionary measures. And if the number is low, the Fed would take expansionary actions. Okay, now moving on to CPI. Now, CPI is the core measurement of inflation. Basically, it measures how much the price of goods and services increased for the consumers compared to the last month or the same month of the last year. Now, for this metric, while we need to monitor both the month-over-month CPI and year-over-year CPI, if I had to pick one, I'll look at year-over-year CPI, meaning that I'll look at the number which compares the price level of goods and services versus the same month of last year. The reason I look at this on a YOY basis is because generally YOY CPI removes any volatility in inflation movements, which may be due to seasonalities or one-off factors. Also, YOY numbers are generally easier to communicate, which is more aligned with the Fed's target of 2%. Month-over-month numbers are naturally much smaller given it compares to the price levels of 1 month before, which results in small numbers like 0.1% or 0.2%, which is a bit harder to comprehend. Okay, now, as I explained multiple times, the Fed has a clear target for this number, which is 2%. Now, for this number, if the number is somewhere around 2%, you can consider inflation to be in a normal state. If it is over 2%, it should be considered a high inflation, and if it is below 2%, it should be considered a low inflation. Now, a small deviation from the 2%, like 10 to 20 basis point, may be okay, but generally, the Fed wants this number to be at 2%. Now, for the CPI, as you may be well aware, the Fed's actions will be contractionary if the CPI is high, and it'll be expansionary if the CPI is low. Now again, as proven by the recent actions of the Fed, a single data such as high CPI does not determine the Fed's actions as shown in recent months. Please take this into account. Again, I'm just laying out a general theory. Okay, now moving on to core CPI. Just like CPI, I would look at this on a year-over-year basis. The difference between CPI and core CPI is that from the CPI, core CPI removes the price levels of food and energy. The reason this metric strips out food and energy is because food and energy are the most volatile items within the components of CPI. Food and energy are highly sensitive to external factors like geopolitical situation or one-off natural disasters, and therefore, removing these two items, the Fed can get a more balanced view about the current inflation level. Now, apart from this point, the mechanism is the same as CPI, both on the economic impact and the Federal Reserve's actions. Okay, now moving on to PPI. PPI, which stands for Producer Price Index, measures the price change of manufacturing goods. Now, PPI is a very important metric given it is a leading indicator for CPI and core CPI. This metric basically measures the inflation from the producer's perspective rather than the consumer's perspective. What this means is that this metric measures how much the cost has increased for the companies to manufacture their goods before selling it to the consumers. Now, generally, if more cost is involved for the companies to make their goods, they'll pass through the increased costs to the consumers at some point, and therefore, we can get a sense of how CPI will turn out to be down the road. Now, given this is a leading indicator and needs to be monitored real time, for this metric, I look at it on a month-over-month basis to get a better sense of how it's moving compared to the previous month. If you monitor PPI very closely, you can get a sense of how the CPI will be in the near term. Now, given this is comparing the price increase versus the previous month, if the number is in between 0% and 0.2%, it should be considered an okay inflation, while anything above or below that should be considered high and low. Now, on the economic impact and the Federal Reserve's actions, it is the same as CPI and core CPI. Now, before I finish off on inflation, while I didn't include it in the list, one other metric you may want to monitor is the core PCE index. While it's a very similar metric compared to the core CPI index, it covers a broader scope of items which the companies pay on behalf of the consumers, such as employer-paid healthcare, and is also adjusted for changing consumer patterns. Therefore, it's a more stable measurement of the inflation which the Fed prefers to base their decisions on. Okay, now moving on to economic activities. First on the ISM Manufacturing PMI. Now, ISM stands for Institute of Supply Management, and PMI stands for Purchasing Managers Index. Basically, this is a data based on a monthly survey conducted with executives in over 300 to 400 manufacturing companies. Now, this is the Fed's favorite leading indicator of the real economy, as the survey asks questions around new orders, production quantity change, employment, and inventories. Basically, it's a survey which tries to see if the manufacturing industry is doing well or not. Now, you don't need to know the details around the calculation of the index, but all you need to remember is that the number 50 means that the economy is at a neutral state, which implies that there has been no change to the manufacturing activity compared to the previous month. Now, the Fed looks at this index to determine how overheated or underheated the manufacturing industry is. While the manufacturing industry is only a small component of the US economy with around 10 to 12% share, it is still a very important metric given the manufacturing industry is generally a leading indicator of the overall economy. Now, on the economic impact and the Federal Reserve's actions, with the number 50 being the neutral state, we can generally assume that any number over 55 means a strong expansion in the economy, while any number below a 50 is a contraction in the economy. Now, on the Federal Reserve's actions, if the number indicates a strong expansion, the Fed will try to cool down the economy with a contractionary measure, and vice versa. Okay, moving on to ISM non-manufacturing PMI. Now, the non-manufacturing PMI covers the services sector, which makes up about 70% of the US economy, and therefore, it is generally the more important indicator in understanding the overall growth and inflation. The services sector generally includes the likes of education, financial services, retail, hospitality, and etc. Now, the price levels of the services sector are generally more stickier than the manufacturing sector, given most of the costs are human labor. Therefore, the Fed generally monitors this metric closely to plan their next moves on defending the inflation. Now, the measurement is generally the same as the manufacturing PMI, and the economic impact and the Federal Reserve's actions are the same as well. Okay, moving on to Chicago PMI. Now, while this metric is very similar to the manufacturing PMI, this metric focuses on the activities in the Midwest region. Now, the reason we look at this is because, number one, Chicago is a manufacturing hub in the US, which many companies supply products nationwide. And number two, historically, Chicago PMI has been acting as a leading indicator for the nationwide manufacturing PMI. Basically, Chicago PMI gives us a preview of how the ISM manufacturing PMI will look like in the next 1 to 2 months, given Chicago is the starting point of the manufacturing activities in the US. Now, on the economic impact and the Federal Reserve's actions, it is the same as other PMI data. Okay, moving on to Consumer Confidence Index. Now, this index measures the level of consumer confidence in economic activity. It is generally a leading indicator which the Fed monitors to get a sense of how the inflation and the unemployment will be in the future. It is measured through a monthly survey conducted with 5,000 households in the US, asking about their sentiment towards their income, employment status, and business conditions. Now, similar to the PMI index, while we do not need to know the details of the calculation, all we need to remember is that the number 100 represents a neutral state. Generally, if the number is in between 100 and 120, it's considered neutral, while above 120 is considered a strong sentiment, and below 100 is considered weak. Now, the Federal Reserve will take actions accordingly. If the consumers feel that the economy is very strong, they would take contractionary measures, while they'll take expansionary measures if the sentiment is weak. Okay, so with that, I've covered all the key data which you need to monitor to understand the economic conditions. As I said previously, please note the following. Number one, a single data does not determine the Fed's actions. As we have seen very recently, despite low unemployment and high inflation, the Fed may decide to lower the rates if political situation or other economic data are not aligned. Number two, while economic indicators are helpful in understanding the macroeconomy, we always need to take further steps to predict the movement of the market. For example, in 2020, when the COVID news came out, all the prior economic indicators became useless as everyone had to make a fresh set of predictions on how the indicators will change due to the pandemic. We always need to monitor the news and adjust the economic indicators accordingly on our own. Number three, while I laid out 10 indicators to monitor, there are millions of other data which can suddenly be important at certain times, and one data may be more important than the other. For example, in recent years, CPI has become the most important economic data, but before 2022, no one cared about CPI. Okay, so with that, I hope you now have a better understanding of reading macro data. Please note that familiarizing yourself with the macro data only comes with time. So please carefully monitor the market to the extent you can, and gradually you'll get a better sense at analyzing the market yourself. I hope you enjoyed the video, and I'll be back with more videos very soon. Okay, now that we have covered the valuation techniques, the Federal Reserve, and the macro indicators, we now put everything together to make our own stock investment framework. I wanted to emphasize that this investment strategy is my own strategy, which you should only use as a reference to come up with a strategy which works for you. Okay, here we go. Okay, so after I started this channel, a lot of you guys asked me to make a video on stock investment strategy for beginners, which I've been giving some thought. Now, the reason I gave it a lot of thought is because, number one, I was not sure how basic it'll have to be to make it understandable for everyone watching while providing some meaningful information. And number two, there's really no right or wrong strategy in stock investing. And number three, there are just too many variables and things to consider to put into a single video. So I gave it some thought and decided to make the video with the following caveats. Number one, the strategy I'm about to explain to you is the strategy which I use. Now, what I'm trying to say is that you may or may not decide to follow this strategy, as I can't really say that this is the right strategy for you. Please consider it as a playbook which you can play around with to potentially make better decisions when you're investing. Number two, I'll avoid explaining every single basics of terminologies and concepts, given they're either available in my previous videos or can be easily understood by searching it yourself. Number three, I don't do short-term trading, so please assume that my entire strategy is based on holding your investment for at least 3 months, up to a few years until you reach a satisfiable return. Now, for the people who are viewing my video for the first time, I suggest you either watch my other videos or watch this video very carefully to fully understand the logic behind it. After all, I just want all of you to learn something from this. And also, if you fully understand the concept of this video, whatever your strategy is, I'm sure you can use this video as your investment playbook to make modifications as you see fit for your purposes. Okay, caveats aside, let's get to it. To explain my investment strategy, I'll first need to explain the Federal Reserve chessboard again. So I've been repetitively saying that the most important aspect to consider when investing, especially post the global financial crisis era, is understanding the Federal Reserve's actions. Now, if any one of you disagree with this and would prefer investing in a stock in the super long term, say 10 plus years, without taking into account of the Fed policies, that is fine too. In that case, this video might not be too helpful for you, but the reason I take into account of the Fed policies is because while I don't short-term trade, I do want to maximize my profits by adjusting my investment portion and types of stocks by taking profits in a few months or 2 years maximum. Okay, I also explained that there are two major metrics which we need to monitor, with the first metric being the Federal Reserve interest rate and the second metric being the Federal Reserve balance sheet. Now, to recap this table, basically the Federal Reserve uses these two tools to control the liquidity in the market. First, on the interest rate, the Federal Reserve can guide it towards being low or can guide it towards being high. Now, if the interest rate gets low, there are two implications which happens. First is, in general, the market's valuation will go up. Now, when I say valuation, I'm referring to the typical valuation metrics like the price to earnings ratio and EV over EBITDA multiple. Now, let me try to explain why this happens. You might remember from my DCF video, which I made as a joke trying to value dating, that when I discounted the cash flows, I used a thing called a WACC. Now, you may remember that the WACC is composed of two things, which are cost of debt and cost of equity. Now, simply put, cost of debt refers to the interest rate the company needs to pay when borrowing money. So if the interest rate goes lower, cost of debt becomes lower. Also, on the cost of equity side, if the interest rate goes lower, a core component of the cost of equity, which is the risk-free rate, which is essentially the US Treasury yield, will also go lower. So you can safely assume that the WACC will go lower if the interest rate goes lower. Now, you're using this WACC to discount the future cash flows of the company. Therefore, if the WACC goes lower, the value of the cash flows will go up. To give you a simple example, if the company is projected to generate $100 of cash flow next year and the WACC is at 10%, the current value of the $100 would be $100 divided by 1 plus 10%, which is $90.9. However, if the WACC goes down to 8%, the $100 divided by 1 plus 8% becomes $92.6. Therefore, the future cash flow of the company will be valued higher, which leads to a high valuation of companies. If the value of the companies goes higher, it'll lead to the price to earnings ratio, or EV over EBITDA multiple, also going higher, because the absolute earnings of the company is fixed while the value goes higher, leading to a higher multiple. Now, the second reason the company's value goes higher is because if the interest rate goes low, interest on bonds will also go lower as well. Now, I don't think I need to explain why that is. Basically, lower interest rate would mean that you'll be earning less interest on a bond. So what generally happens is, because the bond interest rate becomes low, the investors will generally avoid investing in the bond and look for a high-yielding asset like stocks. Therefore, the demand for stocks would increase, leading to a high valuation of stocks. Okay, so that's the first thing that happens. The second thing that happens is, if the interest rate goes low, all companies' debt burden will be significantly reduced. Now, when companies take on debt or issue bonds, companies will need to pay interest on them. Now, if the interest rate goes low, companies with a lot of debt will be reduced with the burden of paying interest on them. And even if companies don't have any debt, they'll be less reluctant to take on the debt because interest rate is very low. Now, under this scenario, which companies do you think will benefit the most? Basically, the companies which are expanding rapidly and growing rapidly will benefit the most. I mean, companies which are not growing and only full of debt will also benefit, but I'll not go into those companies because we shouldn't invest in those companies. Okay, so going back to my point, the companies which are growing and expanding with a lot of debt, with not much money because they're not generating profits, will benefit the most. Okay, so those two are the biggest things which happens when the interest rate is low. Now, if the interest rate is high, it's the opposite. Market valuation will go down because WACC goes higher, and there will be some shift from stock investors to bond investors. Also, companies with high profit and cash flow will benefit. Obviously, high growth companies are always good, so I won't put that down here. Okay, so we covered the interest rate. Let's move over to the Federal Reserve balance sheet. Okay, so if the Federal Reserve balance sheet is increasing, this means that the Federal Reserve is buying assets and increasing their balance sheet. The assets which the Federal Reserve buys are mostly treasury bonds and mortgage-backed securities. Basically, you can think of the scenario as the Federal Reserve conducting the quantitative easing. Now, under this scenario, I explained in my whether QE and bailout should be allowed video. Basically, two things happen. First thing that happens is, because the Federal Reserve purchased so much bonds from financial institutions, these financial institutions receive so much cash in return that they become extremely eager to lend the cash to people and corporates. So obviously, the first thing that happens is it becomes extremely easy to borrow money. Now, as I explained in my previous video as well, because these financial institutions are so eager to lend money, money becomes extremely cheap, and people can borrow at a very low borrowing rate. So that's the next thing that happens. The borrowing rate becomes very low. Okay, now, if the Federal Reserve balance sheet decreases, you can think of it as a quantitative tapering scenario. Basically, the Federal Reserve is draining the money in the market and sucking it up by either selling the bonds to financial institutions in return for cash, or just not doing anything and letting the bonds mature. So under this case, it'll be the opposite of the balance sheet increasing case. So basically, it'll be harder to borrow money and the borrowing rate goes higher. Okay, now up to this point, we have covered the implications of the Federal Reserve policies. Now let's move over to the actual stocks. So let's assume there are 4 stocks: Stock A, Stock B, Stock C, and Stock D. Okay, so when looking at a stock, while there are millions of things you should be looking at, if I were to pick 4 major metrics to look at, those would be, Number 1, revenue growth. Number 2, earnings growth. Number 3, forward price to earnings ratio. And number 4, debt to EBITDA ratio. Okay, now please keep in mind that I'm just giving some examples of stocks just to give you an idea how you can play around with the stocks in accordance with the Federal Reserve environment. Now, revenue growth is straightforward. Also, earnings growth is straightforward. Basically, you just take next year's earnings and divide it with last year's earnings and see how much growth the company is recording. On the forward price to earnings ratio, please refer to my price to earnings ratio video. I just want to emphasize that for the price to earnings ratio, you should not look at trailing price to earnings ratio. For example, right now it's early 2025, so don't use the price to earnings ratio by using the 2024 earnings, but use 2025 year-end expected earnings to derive the expected price to earnings ratio. The reason is, number 1, the investors generally care about what will happen to the company's future earnings as they're forward-looking. And number 2, historical earnings can be heavily distorted due to one-off earnings or losses. Okay, on the debt to EBITDA ratio, the only reason I look at this is because I try to find out how much leverage the company has. Also, the level of leverage a company has become increasingly important given the drastic monetary and fiscal policies which the Federal Reserve is adopting these days. Basically, the level of debt a company has would drastically determine the company's valuation level given the interest rate they pay on the loans, and their ability to refinance the loans can get significantly easier or challenging depending on the Federal Reserve policy environment. Now, EBITDA is the most representative metric which the company generates from its operations as it adds back interest, taxes, and depreciation and amortization. So you can just simply think of it as a free cash flow metric, which the company generates every year. Now, by looking at the debt to EBITDA metric, you're able to figure out how many years the company will take to pay down its debt. Okay, so starting with Company A, let's assume that Company A has revenue growth of 5%, earnings growth of 5%, price to earnings ratio of 10x, and debt to EBITDA ratio of 1 times. So basically, Company A has humble revenue and earnings growth, but is trading at a very low valuation of 10 times price to earnings ratio, and its debt to EBITDA is at 1 times, which means the company has almost no debt. So the Company A is very stable company with little growth and no debt. Okay, for Company B, let's assume that Company B has revenue growth of 10%, earnings growth of 10%, price to earnings ratio of 20 times, and debt to EBITDA of 3 times. So basically, Company B has some growth, but is trading at a slightly higher valuation of 20 times price to earnings ratio, and its debt to EBITDA is at 3 times, which means the company has some debt. So Company B has okay growth, slightly high valuation, and some debt. Okay, for Company C, let's assume that Company C has revenue growth of 20%, earnings growth of 10%, price to earnings ratio of 25 times, and debt to EBITDA of 5 times. So basically, Company C has high growth, but is trading at a high valuation of 25 times price to earnings ratio, and its debt to EBITDA is at 5 times, which means the company has high debt. So Company C has high growth, high valuation, and high debt. Okay, for Company D, let's assume that Company D has revenue growth of over 50%. It could be 80% or 100%, but let's assume it has a very high growth profile. Also, Company D is recording losses, so there's no such thing as an earnings growth or price to earnings ratio. Let's also assume that Company D has a huge debt. But given the company doesn't have any earnings, its EBITDA is also negative. So debt to EBITDA can't be calculated. Okay, so let's go back to the Federal Reserve chessboard to see which stock we should buy in each of the periods. So let's start with the fourth quadrant, which is the least liquid period. Basically, the interest rate is high or getting higher, and the Federal Reserve balance sheet is decreasing. Basically, very little liquidity is in the market. Okay, during times like this, In terms of making the investment, I would personally not invest over 20% of my cash or even just sit on the sideline to observe the market. I would think that this would be a very risky time to invest given the stock valuations are getting lower and getting loans is not easy for companies as well. But if I had to choose a stock to invest during this period, I would choose stock A. Now, the reason I'll choose stock A is because despite the low growth the company is recording, the low level of leverage which the company has will keep the company solvent. Also, given the company's valuation is already very low at 10 times, the increase in the WACC will not impact the company's valuation that much. Basically, if your nominator is high, increase in the denominator will have a much significant impact in absolute terms. Now, percentage-wise, it may be the same, but my observation on the market is that if a company with high valuation multiple is impacted by increasing interest rate, it'll trigger the sell-off mentality of the investors and the stock may experience a huge drop. So to play safe, I'll prefer investing in stocks like Company A. So let's move on to the third quadrant, which is the in-between period. Basically, the interest rate is low or getting lower, and the Federal Reserve balance sheet is decreasing. Basically, there's some liquidity in the market. Okay, during times like this, for the investment, I would personally not invest over 50% of my cash. Or, same as the fourth quadrant, I'll just sit on the sideline to observe the market depending on the circumstances. I think you will need to invest in stocks quite selectively during times like this too, given liquidity is still there, but not always there. Okay, for the stock, if I had to choose a stock to invest during this period, I would choose stock C. Now, stock B and stock C would both work, but I would prefer stock C. The reason I would prefer stock C is because Company C has high growth, which would definitely be valued in the market, but also has high leverage. Now, assuming Company C already has enough debt it needs, it'll benefit a lot from the decreasing interest rate. Now, because it has enough debt, it won't have to borrow a lot of new money and just refinance the existing loans, so it would work even under an environment when the Federal Reserve balance sheet is decreasing. Also, while the valuation of Company C is quite high, as long as it can maintain the revenue growth, its valuation will be justified given its low interest rate environment where the WACC is going lower. Okay, so let's move on to the second quadrant, which is also the in-between period. Basically, the interest rate is high or getting higher, and the Federal Reserve balance sheet is increasing. It would be similar as the third quadrant, but slightly different in the sense that the interest rate is high. Okay, during times like this, for the investment, same as the third quadrant, I would personally not invest over 50% of my cash or just sit on the sideline to observe the market. Again, I will need to invest in stocks quite selectively during times like this as well. Okay, for the stock, if I had to choose a stock to invest during this period, I would choose stock B. Now again, stock B and C would both work, but I would prefer stock B. The reason I would prefer stock B is because Company B has some growth, which is okay, but also has some leverage. Now, given Company B has some leverage, but not as much as Company C, it should be relatively okay under a high interest rate environment. And also, while price-to-earnings ratio is somewhat high, but it is not as high as Company C's, so the impact from the WACC going higher would be relatively controlled. Okay, now let's move on to the final quadrant, which is the first quadrant. Okay, now in this quadrant, I will super aggressively invest into the market. I mean, I'll not only invest 100% of my cash, but if possible, even take on loans to invest. Basically, this is a period where the Federal Reserve is decreasing the interest rate and conducting the QE at the same time to increase its balance sheet. Also, in terms of the stock to invest, I will invest in stock D, which is recording excessive growth with no earnings. Now, as I said multiple times in my previous videos, this is the time when the companies rarely go bankrupt. So you do not need to worry about the amount of debt a company has, given they should be able to either refinance the loan or get more loan from the bank. Also, the financing cost is extremely low, so the company would not have any issues in paying the interest with more debt or equity. Also, given the low interest rate, this is the time when people hunt desperately for growth. All the money in the bond market will shift away to stocks, and given there's so much liquidity, they'll just look for fast money where the growth can be achieved. Okay, so I'll invest in Company D during this time, but I will make one single caveat though. For a stock like Company D, you really need to exit the investment at the right time. When you feel like you gained a lot of profit, or when you feel like there's any, and I mean any signs of the interest rate going back up or the quantitative easing ending, you have to sell the stock right away. Don't get swayed away with the media or Wall Street bets screaming to the moon or whatever. Just sell. 20% profit, 50% profit, 100% profit, 200% profit. These are all great. Just hit the sell button whenever you see any signs of any changes happening in the market. Okay, guys, to wrap up, I'll note a few things. Please listen carefully. Number one, a stock with Company D's growth and Company A's valuation and leverage ratio would be the best in all scenarios. If you can find a stock like that, go for it. However, there are not many companies like that out there. So that's why I'm giving these illustrative examples with made-up companies. Number two, when you pick a stock, please compare it against other companies within the same sector. Try to check whether the company's valuation or growth is lower or higher versus its peer companies and take that into consideration when investing. Number three, don't chase for fast money. The more you chase it, it'll run away. You don't have to invest and hold a stock for 20 years, but at least say bye-bye to your cash for the next 6 months or 2 years when you buy a stock. It may go down in the short term, but if you did your work, you have the chance of succeeding down the road. Okay guys, so this is the end of my investment strategy video. But now, I do want to emphasize again, and please listen to this. This strategy is my strategy. It may work for you or may not work for you. But if you understood my points correctly, you will learn something from it, and you should be able to use this information in your own way to make your own investment decisions. Now, the reason I made this video is to help you make better decisions, so I really hope all of you guys succeed with your investments down the road. Thank you, and I'll be back with more videos very soon. Okay, now that we have covered the valuation techniques, the Federal Reserve, the macro indicators, and investment strategy, we move on to the right investment mindset we need to have to succeed in investing. I've seen plenty of people fail in investing even when they have decades of experiences in investment banking, private equity, and hedge funds, so I just wanted to emphasize that everything comes down to having the right mindset. Okay, here we go. Okay, so until today, in my videos, I talked a lot about investment tactics, strategies, valuation theories, and market updates, which focuses on the technical aspects of investing. In my stock investment strategy for everyone video, I talked about how you can use the monetary policies to your advantage when investing. In my PE ratio explained video and EV/EBITDA explained video, I talked a lot about the key valuation theories which are most commonly used when making investment decisions. Also, in the various market update videos, I talked about the recent events that took place in the market in detail, which can be helpful in positioning your investments. Now, while I talked about a lot of the stuff related to finance investing, I mostly focused on technical aspects of things, which are generally helpful in enhancing your knowledge. Now, however, up until today, I didn't really talk about the more important aspect of investing, which is having the right mindset. Now, I wanted to emphasize that whatever skills and knowledge you have, if you don't have the right investment mindset, you'll most certainly fail. A lot of you may wonder whether my colleagues who are working in investment banking and private equity are all super successful when it comes to personal investing, but I can tell you with the utmost certainty that not even half of them are successful. But at the same time, I can also assure you that those guys who work in the industry have the most in-depth knowledge about finance, macro, valuation theories, and various industries. However, I've seen many, and I repeat, many of them fail in personal investing miserably. Now, one thing I'll add is that they do have a higher chance of doing better versus the people who have no knowledge at all. However, nothing is guaranteed. And I've seen them failing miserably in their own investing. Now, why is this? The only one reason why this happens is because people, regardless of what knowledge you have or what background you have or what industry you work in, does not have the right mindset when it comes to investing. Now today, I wanted to cover this topic in detail based on my personal experiences as well as my observations around me. Okay, let's get to it. Okay, so when it comes to having the right mindset for investing, first, I wanted to make some overarching statements. There are millions of videos on YouTube or any other social media channels about having the right mindset for investing. Now, I have a huge issue with these videos, and I think almost all of the videos are scams because of the following reasons. Number one, most of the videos tend to generalize the right mindset when investing. A lot of the videos get fixated on a certain mindset you should have when investing and forces you to accept having that mindset as a holy grail. Now, the problem with this is that what I have come to realize throughout my life and looking at myself as well is that for every single one of you watching this video, the right mindset you should have is totally different from one another. I've come to realize that every single person's innate character is almost impossible to be changed. And depending on what kind of person you really are, you must find the right mindset that fits you. Now let's think about some general advice people give to each other. Parents generally tell their kids that you should do well in school. Now, if that was that easy, everyone would only be getting A grades in school, and everyone would be going to a good college. However, the world does not work that way. Also, there are millions of people in this world who didn't do well in school but still become successful entrepreneurs, entertainers, athletes, salesmen, and etc., who do very well in their lives. Now, if you told the kids who are doing well in school to drop what they are doing and try to replicate the people who are successful despite not having any college degrees, it may be tremendously difficult for them to do so. Also, it would be the case the other way around as well. So the point I'm trying to make here is that there are certain characteristics which people are born with, and we need to embrace it to find the right investor's mindset which fits each of us. Number two, most of the videos don't reflect reality. Now, I've seen a lot of videos on YouTube and other channels referencing the likes of Warren Buffett's mindset, which spans across almost 70 years, and typical DCA mindset, which also spans across decades of years. Now, I wanted to make it clear that I do believe that having those kind of mindset are good. But the problem is that generally, people don't set a 50-year or 70-year target and try to invest that long of a period. The reason this typically doesn't work is, number one, the speed of asset price going up in the past 10 years is incomparable to how fast it went up before then, and therefore, participating in the market with a sane 100-year time span mindset is very difficult. And number two, given the high inflation we're experiencing, there are multiple occasions where people have to pull their investment out to fund their day-to-day lives. Okay, so those were some of the thoughts I wanted to share about the existing Investors Mindset videos. Okay, so having that said, how should we approach investing? So these are some of the thoughts I wanted to share with you today. Number one, have your own principle and stick to the principle. Number two, don't get swayed away with noise and stick to the principle. Number three, review your principle on a regular basis. Number four, once you invest your money, remove emotional attachment from the money. Number five, don't talk to other people about what you bought or sold. Okay, so let's go through the points one by one. Number one, have your own principle and stick to the principle. So from my perspective, this is the most important point when it comes to investing. So as you may have seen from my previous videos, there are tens of millions of ways to invest. You could do long-term investing, mid-term investing, short-term investing, scalping, value investing, narrative investing, options trading, swing trading, momentum trading, and etc. Also, when it comes to the securities you invest in, you could invest in public stocks, private stocks, bonds, cryptos, FX, commodities, and etc. So there are endless ways which you can invest your money. Now, I can say with 100% certainty that all of the investing strategies and securities which I mentioned will work if you do it the right way. There are many people who already succeeded in each of the investment methodologies, and if there's a case of someone succeeding, you can do it too. Now, the problem is, while an investment strategy may work for somebody, it doesn't work for everybody. The reason it doesn't work for everybody is because each investment strategy requires certain soft skills and personalities which are designed to fit the strategy which you're about to adopt. For example, long-term investing requires patience and endurance. Value investing requires natural instinct on numbers and industries. And scalping strategy requires a gifted intuition on market movements. So depending on what kind of person you are, there will be an investment strategy which fits your personality. Let me give you my example. When I tried to assess myself from an objective point of view throughout my life, I made a few conclusions about my character. A, I'm a person with a day job and will most likely remain that way for the foreseeable future, so I can't be trading stocks all day long. B, I'm a rather risk-averse person, so speculating will make me very uncomfortable. C, I've gotten feedbacks from numerous people that my strengths are numbers, patience, and perseverance. Okay, now taking into account of those factors, I've made the following conclusion about myself. Number one, short-term trading is not a good fit for me, so I need to trade mid to long term. Number two, given my obsession with numbers, I need to take valuation into consideration. Number three, to invest with a more peaceful mindset, I need to follow the macro closely and time the market correctly. So based on all those considerations, I built my own principles of investing. Now, I laid out my investment strategy in detail in my stock investment strategy for everyone video, but just to recap a few key points. A, I invest heavily when the market is transitioning towards a more liquid environment. I already demonstrated to you guys how I do it when I said that we should buy into the market in early April of this year. In April, it was a good time to buy into the market because, number one, interest rate was showing signs of going down from the second half of the year. Number two, valuation level came down to a reasonable level. And number three, the government was being cavalier about high inflation, which gave more comfort for the market. Okay, moving on to the next point. B, whatever stock I buy, I try to build numerical logic. You guys can refer to my previous investment videos, including Plug Power, NIO, and Nvidia, but I try to set a clear numerical logic behind my purchase price and my exit price. Now, when the market is extremely liquid, I tend to be a lot more aggressive on valuation by looking at price to revenue type of multiples. And when the market is less liquid, I tend to stick to more traditional valuation multiples, like price to earnings ratio or EV/EBITDA ratio. I explained in detail about the PE ratio and EV/EBITDA ratios in my previous videos for your reference as well. C, I try to hold on to my investment in the mid to long term. Now, I generally try to hold my investment for more than 3 months at the minimum, but this is not because I set a hard rule on how long I'll hold on to my investment, but it's because it generally takes time for the market to reflect my logic in the share price. If my target price on the stock is 3x the price I bought, it generally won't reach that price in a single day. Okay, so that kind of wraps up my thoughts on my first investment mindset. Now, moving on to the second point. Number two, don't get swayed away with noise and stick to the principle. Okay, now what I mean with this is that when you have formed your own investment principle, stick to it and don't look elsewhere. Now let me give you my example. As I told you guys multiple times, I started working from early 2010s and only started investing from late 2019. Now the reason I didn't invest at all for almost 10 years was a mix of reasons. I needed time to figure out what kind of person I am and forming my own investment principle, which took me a lot of time. And also, I couldn't spot the right opportunity to invest based on my investment principle. Now, obviously, during those times, I saw plenty of people getting rich with stocks and cryptos or whatever, but I tried very hard to not get swayed away. Now, even today, I see plenty of people getting rich every day. I see people getting rich overnight with one huge bet on options with stocks, but I don't care. I see people making huge exits on angel investments in private companies, but I don't care. I see people making huge bets on cryptos and getting rich, but I still don't care. I see people making money with short-term trading and scalping, but I really don't care. Now, what I know is that the moment I start looking away from my own principle and try to follow the path of others who are making big on the market, I become a follower who gets dragged into the game rather than a leader who is consciously making my own decisions. Now, this is a huge difference on your mentality when you're investing. If you guys want to know what happened when I deviated from my own investment principle, please refer to my How I Lost $100,000 in One Day video. This was one of the few times when I got dragged into the game rather than making my own conscious decision. And the result was that I lost 100K in a single day. I think this video will be quite informative for a lot of you guys, so please watch the video if you haven't already. Okay, moving on to the third point. Number 3, review your principle regularly. Now, the reason I think this is important is because oftentimes people forget that they could be wrong. Now, this usually happens to investors who are relatively new in the market with less experience and believe that your own principle is the way to go. Now, the reality is that the market is a very shrewd animal and your investment strategy may not work as the market evolves over time. You need to test your principle regularly and thoroughly. And if you think your investment principle is not working, you need to be nimble with your approach. But again, don't shift your investment principle by listening to other people. Come up with your own logic and principles. Otherwise, you'll be dragged into the game, which will most likely lead to a failure. Number 4, once you invest your money, remove emotional attachment from the money. Okay, so the reason I believe this is very important is because I saw plenty of cases around me where people involve emotions when investing and leading themselves to failures. Now, obviously, I know a lot of colleagues in the hedge fund and private equity world whose job is to invest. Now, oftentimes, those guys are very good investors when it comes to their job and rarely loses money. However, as I said previously, I saw plenty of guys being terrible when it comes to personal investing. And the whole reason they can be so bad at it is really only because they involve emotions when they're investing their own money. Generally, when you're dealing with other people's money, you become cold-hearted, very illogical, sticking to the investment principles of the firm, thoroughly investigating every price of the company, and etc. But once they start investing their own money, they suddenly start chasing after Nvidia, Tesla, Bitcoin at the worst time possible, and exit at the worst time possible, losing huge amount of money. Now, why is this? This is really only because they get emotions involved with money. They get impatient, anxious, and hot-tempered when investing their own money that they become a completely different person. Okay, so please, when you make an investment, please separate your emotions and just think about your logic and principles only. And after you invest, just consider it someone else's money, like a money you gave to a company for them to use to make the company better. Now, from this aspect, if you're a mid to long-term investor, but checking your brokerage account balance more than 3 times a day, there's something wrong here. Okay, moving on to the next point. Number 5, don't talk to other people about what you bought or sold, even on the internet. Okay, so this may be a controversial point as it may not apply to everyone, but let me explain. Throughout my days of investing, I've come to realize that if I share with other people on what I bought or sold, I become extremely agitated and anxious that oftentimes I find it hard to stick to my principles. It's kind of like strongly recommending a restaurant to a friend and telling him or her to try the food at the restaurant. If you end up taking your friend to the restaurant by recommending it really hard, you may become a bit anxious about how your friend may react to the food. Now, if you went to the restaurant by yourself, you may have just enjoyed the meal and finished the meal with a peaceful mindset. But once you have someone sitting in front of you who came just because you recommended it, you may become a bit anxious about his reactions. Now, I think it applies the same to investing as well. If you built an investment thesis based on your principles, it's generally more helpful for you to keep it to yourself. At least that's how I felt. Okay, so I went through all the common mindset which I think are important when investing. Now, as I say all the time, even the right investing mindset may vary from a person to another. So please remember that these are my principles and mindsets which I try to stick to. You may have your own version of it, so just think of it as a sample guide for you to consider. Okay, so that's all I wanted to cover today. I hope you enjoyed the video, and I'll be back with more videos very soon. Okay, now that we have covered everything, I wanted to end the video with a bonus clip on a simplified way to make money in the stock market. Remembering all the theories and the metrics may get tough, so I came up with a few critical things to monitor to avoid losing money and maximize your chances of making money in the market. Okay, here we go. Okay, today I wanted to talk about a general topic about investing. And over the past year, I produced some contents which are focused around the ways to invest and how to be successful when investing. And a lot of the contents which I produced in the past were kind of spread across different topics. So I wanted to kind of bridge that gap and come up with a very simplified version of how to actually make money in the stock market. Now, before I begin, I just want to let you guys know that there are 3 contents in my library which I believe you should really watch. Now, I think those 3 contents combined would give you generally a good idea about investing. And even for those of you who are not that familiar with the technical side of things, like how to value companies and how to do DCFs, or how to come up with valuation metrics, or how to monitor the trend of the market, I think those 3 videos combined should give you a pretty good idea of how to successfully invest in the stock market. And those 3 videos are, number 1, the stock investing strategy for everyone video, and number 2, macro investing 101 for beginners, and number 3, you'll certainly fail without the right mindset video. So for each of the video, for example, for the stock investing strategy for everyone video, I talked about how the Federal Reserve framework impacts the overall market, and within the Federal Reserve framework, which time you should invest your money and how much, and in which stocks as well. In the Macro Investing 101 for Beginners video, I go further in depth into the macro indicators and what we should monitor and how we should interpret those data. And number 3, in the most important, you'll certainly fail without the right mindset video, I talked about the kind of mindset that you should have in order to be successful in investing. And I also emphasized that, I worked in investment banking and private equity for almost 15 years. And even among my peers, there are plenty of people who are very well equipped with the technical knowledge about investing and about the market. But at the same time, when it comes to their own investment, a lot of them fail because they don't have the right mindset. So before you watch this video, I really suggest that you go back and watch those 3 videos multiple times to get a sense of what a successful investor should be equipped with in terms of the knowledge of the market. Okay, and I also want to let you know that in April 2025, I gave you guys the first buying call through my video, and in March 2026, which is about a month ago, I also gave you the second buying call, which I thought was a good timing to buy into the market. And for the investments which I made, for the April 2025 investments, I've told you guys that I'm already up about 75 to 80%. And for the investment which I made about a month ago, which I allocated between the Mag 7 stocks and the semiconductor stocks, I'm up by about 20 to 25%, 40 to 45% respectively. And in my previous videos, I talked about the concerns I have about the market, and the fact that it's rising too fast. And despite all the red signals which are still lingering in the market, including the inflation, the oil price, the new Fed chair, the earnings growth trajectory and everything, and the valuation as well, but the market is still going up. So, we would need to monitor what happens in the future very carefully. Now, that aside, I just wanted to kind of give you a very simplified version of how to time the market correctly and how to actually make money in the stock market without going into too much details of the technical side of things. So, even if I give you this kind of guidance, a very simplified one, make sure you go back and watch my previous videos as well, because that's going into the more in-depth sides of the things I'm about to say today. But for those of you who have a hard time understanding everything which I said in my previous videos, I think this video may be helpful for some of you who are just kind of getting started and who want to monitor metrics one by one. Okay, so let's begin. Okay, so to simplify all the investment strategies which I laid out during the course of the past year, I want to talk about the investments and the buying calls which I gave you within the past year. So one was in April 2025, and the other one was in March 2026. Now, when I told you guys that I'll now buy into the market, obviously I monitored everything which I could, including the Federal Reserve sentiment, as well as the geopolitical developments, as well as the political situation, which was involving Donald Trump, Scott Bessent, and potentially the new Fed chair coming in as well. So I've been monitoring tens and hundreds of metrics before I actually came up with that decision. But if you compare the April 2025 decision which I made and the March 2026 decision which I made, there are common aspects and elements which kind of ties in between the two decisions I made. And I think there are about 5 things which were happening during the both periods. And I just want to give you a sense of what those 5 indicators are and how you can use it to your advantage. Okay, so the first one is VIX, which is VIX. Now, if you compare April 2025 and March 2026, one common thing that was happening between the two periods was that the VIX was at over 30. Now, for those of you who are not familiar with the VIX, it's basically the CBOE volatility index that tracks the implied volatility. Now, to speak in plain English, it basically means that it measures the volatility of S&P 500 options over the next 30 days, and it mathematically prices the fear. So basically, just think of it as if the VIX is high, there are a lot of fear in the market. Now, generally, on average, when the market is very calm and is generally on an upward trend, the VIX would be in the range of 15 to 20. And if the market is really optimistic and has been on a very great trajectory, it could go down as low as 10 or even below 10. And the band of the VIX could be between single digits, highest single digits, and 20. So the VIX on a daily basis would make its movements, but generally it would move within the band. However, when I made my investments and when I gave you the buying calls back in April 2025 and March 2026, the VIX was at over 30 for both periods. basically it means that the market was trapped in a very fearful emotion. And that kind of represents what the public was thinking about the market. Now, the second metric I wanted to lay out is that for both periods, the Federal Reserve's outlook on the interest rate was that the Federal Reserve interest rate is not on an upward trajectory. So basically what I mean is the Federal Reserve by any means was not indicating that the interest rate was going to go up in the near term. Now, as I've mentioned to you guys multiple times, the federal funds rate is basically the most important metric when it comes to the valuation of stocks. Given that the Federal Reserve rate acts as the basis of the discount rate of the future cash flow of the companies, if the rate goes higher, there'll be a higher discount rate that is applied on the future cash flow of the companies. So when you discount the cash flow back to the current moment, it would basically mean that the cash flow would be smaller when you discount it back to the present day, i.e. the valuation of the stocks and the potential market cap of the stocks would also go down. Now, on the flip side, if the interest rate goes lower, that would mean that the discount rate of the future cash flow of the companies would also be bumped up in accordance with the decrease in the interest rate. So you can just think of it as if the interest rate goes down, it's positive for the valuation of the stocks, and when it goes up, it's negative towards the valuation of the stocks. So that's the second metric that you should monitor. And for both of the periods, it was the case that the Fed was not indicating in any way that the interest rate would go up. Now, in March 2026, based on the dot plot that was suggested by the Fed, it was indicating that the interest rate may stay constant throughout the year. However, by that, it doesn't mean that the interest rate would go up. And also, we had the new Fed chair, Kevin Warsh, who was coming into the market saying that the interest rate could be brought down very quickly. So that was also reflected in the sentiment of the market. Now, the third metric, which I want to mention, is the debt margin, i.e. the FINRA margin statistics. Now, in both of the periods, the FINRA margin statistics, which basically represents the total debt balances in customer securities margin accounts, i.e. the money borrowed from brokers to buy stocks, was on a decreasing trend. Now, what that means is that basically there were a lot of leverage in the market, which generally goes up when the stock market also goes up, has been on a decreasing trend because the stock has been going down for at least a certain period of time. So when the stock goes down, there are people who are deleveraged given that they get margin calls by the brokers. So I'd like to say that when you are looking at the market may go down, but in order to give you a more concrete rationale in buying into the market, what helps is that if the leverage in the market is also going down, it gives you a more concrete basis to buy into the market because the deleveraging in the stock means that there are more room for people to leverage in the future. Now, what I will say is that FINRA's margin statistics are generally posted on a delayed basis. So, for example, the April 2026 margin data would be released about 3 to 4 weeks after the end of April. So when I gave you the buying calls back in April 2025 and this time in March 2026, the margin statistics which I was able to monitor was about a month before from the time when I actually gave you guys the buying call. So in April 2025, I was probably looking at February 2025 data because it was in early April. And in March 2026, given it was late March, I was also looking at about February 2026 margin data. For both of the periods, I was able to see 1 month of deleveraging on the data. What it means is that in April 2025, I was probably monitoring the February 2025 data because I gave you guys the buying call in early April. So the data which I was able to see was as of February 2025. And I saw that from January 2025, moving into February 2025, there was a decrease in the margin balance. Also, this time in March 2026, when I was giving you guys the buying call, I was able to see that the February data, which was already released, suggested that moving in from January to February, there was a decrease in the margin balance. Okay, when you see that the margin has been on a downward trajectory, it suggests two things. Number one, the market is deleveraging, which means that the market has been falling for at least 1 month or almost a month. And number two, if you've been seeing the real-time market also falling within that respective month, i.e. April 2025 and March 2026, it also suggests that there's a pretty high chance that there has been further deleveraging in the market. So you could monitor that on FINRA website if you search FINRA margin statistics on Google. Now, the fourth area which I wanted to mention is that both of the times there were clear leading sector in both of the cases. So basically what I mean is that in order for the market to go up, and in order for the market to have the power and the energy to go up in the future, it generally requires a thematic engine to attract institutional capital. Now, in both of the cases, it was more so in April 2025 that it was more of the Mag 7 stocks. And in March 2026, it was more towards the semiconductor stocks. And that's the reason why I decided to invest in those two themes back in April 2025 and this time as well. Now, the fifth area which I wanted to mention is that now for those leading sectors, that leading sector's earnings profile needs to be on an upward trajectory. Now, the leading companies must provide their dominance via the actual audited financials. And if they beat the EPS and the revenue estimates during a macro panic, it confirms that the underlying business model is insulated from the broader economic fear, which means that if the fear goes away, there's a very high chance for these leading sectors to be on an upward trajectory again. Okay, so those are the 5 metrics which I suggest that you monitor every day in order to gauge the timing of buying into the market, and I do the same as well. Obviously, there are hundreds and millions of other data which I monitor on a regular basis, but that aside, if you monitor these 5 metrics and try to gauge the timing when all these 5 metrics actually checks the box, you'll almost certainly not lose money in the market. Okay, so that's that. Now, one thing I'll say though is if there's a specific time within your investment horizon where all those 5 boxes are checked out, I would say that the probability of you making money is about 80 to 85%. Now, why is it not 100%? Now, for example, 80 to 85% chances is a really high probability. And generally, if those 5 boxes are checked out, especially after 2008 when the Fed adopted the quantitative easing, you should be able to make money most of the times when those 5 conditions are met. For example, let's think about some times when all those 5 metrics were actually satisfied. If you go back to 1997, during the Asia financial crisis era, all those 5 conditions were met. And after a pretty big correction in the market rebounded. So that's one of the times when you're able to make money monitoring those 5 metrics. And also in 2011, when there was a euro crisis and US downgrade, the VIX went up to almost 50 and the Fed maintained the zero interest rate policy. That time as well, if you bought into the market at the right time, you would have made a lot of money. It also happened in 2018 as well, when Powell suddenly decided to raise the rates, which panicked the market. However, after some time, market also recovered after VIX spiking to almost 35 or over 35 to almost 40. It also happened in 2020 during the COVID crash. So during 2020, the VIX went up to almost as high as 83. But then, when the Fed decided to pivot, the market recovered very quickly. And also, there were leading industries which were mainly focused towards the tech industry. It also happened during the 2 periods which I just mentioned, which is April 2025 and March 2026. For both of the periods, the VIX was at over 30. The Fed was not increasing the interest rate. There was deleveraging happening in the market, and there were leading industries which were predominantly leading the market upwards. And also, those leading industries were recording healthy EPS and revenue beats versus the consensus. So 80 to 85% of the times, I would say that the strategy would work. Now, what about the other 15 to 20%? Now, the reason I give 15 to 20% of room is because of the fact that there are certain times when there are systemic imbalances in the market. Now, these are the times when there's so much fear in the market and there are leading industries and the industries are recording a healthy growth And also, the Fed is pausing the interest rate hike or even aggressively decreasing the interest rate. But there's so much panic in the market that the systemic imbalance is causing the market to go down and down and down even further from the previous highs. Let me give you some examples. For example, in 2000 to 2001, during the dot-com bust, the model basically failed because of the fundamentals of the leading sector were completely broken. Now, when there's a situation where the market has been driving upwards due to one or two very nascent sectors, it could cause a significant crash if the fundamental trust in the industry goes away. Also, if there were significant leverage that were adopted into the market in order to buy into those stocks, the power of the deleveraging and the speed of the deleveraging may not be able to be caught up with the Fed, which is also decreasing the interest rate at the same time. So basically what I mean is if there's too much leverage, which is concentrated in a few sectors, which is not generating meaningful earnings, which basically breaks the trust within everybody's mind, the deleveraging may take place in a manner which the Fed cannot intervene to stop the market psychology from fundamentally breaking. So from 2000 to 2001 was a representative period when the VIX was obviously spiking high and the Fed was aggressively cutting the rates from January 2021. And the Fed was cutting the interest rate from almost 6.5% to 1.75%. The margin debt plunged from almost $300 billion to $140 billion. So basically what happened was the clear leaders posted catastrophic earnings misses, which fundamentally broke the trust in everybody's mind. So the deleveraging happened so fast that the Fed decreasing the interest rate was not playing any role in the market. The Fed just had to watch the market crash and there was nothing they could do. Now, the fundamental reason this happens is, as I explained in my Is AI a Bubble video, companies like Cisco, Sun Microsystems, and Yahoo saw revenue growth evaporate. Rate cuts couldn't save the companies trading at 150 times price to earnings with deteriorating cash flows. So if there was a huge bubble in the market which has gone out of the Fed's control, this may cause a systemic imbalance which, even when the 5 conditions are met, the market would still be on a free fall. Now, the second example I want to give you is the accounting scandals in 2002. So this is when the trust collapses. So basically, during that period, all the 5 boxes were checked out. For example, the VIX was at over 40. The Fed was at 1.75%. So they were not on an upward trajectory with the interest rate. And the margin was dissipating. And there were clear sector leaders, including the financials and telecoms, which were reporting strong earnings. However, when the market found out that the earnings were literally fabricated, the market panicked to the extent where no one could save the market. The systemic fraud of Enron, WorldCom, and Tyco basically broke investors' trust in SEC filings. So if you cannot trust the 5th metric, which is the strong earnings growth, the model is void. So basically the market sank to lower lows until October 2002, which means that the market was on a free fall for almost half a year. Now the other example I want to give you is the great financial crisis in 2008. So basically, this was an ultimate systemic liquidity failure. So all 5 boxes were checked out in March 2008, but that also created a massive bull trap. So if you break down the metrics, the VIX basically skyrocketed. The Fed was aggressively cutting the rates. The margin debt was unwinding. Energy and basic materials were the undisputed market leaders, and ExxonMobil was printing record expectation-beating profits. However, this also caused a systemic failure because the commercial banking system's toxic MBS hadn't fully detonated. Even though the Fed cut rates, banks stopped lending to each other. If the interbanking lending system fails, there's going to be a huge liquidity as well as a credit crunch in the market, which could basically freeze everything. And when everything is frozen and there's no credit in the market, even if the Fed continuously injects money and gives message to the whole world that everything's going to be okay, nothing works because no one is willing to lend the money to each other. So when there's a credit crunch and a significant failure of derivatives or off-the-book securities which nobody knew about, or not everybody knew about, this could cause a huge systemic failure, which could ultimately impact the market to a near irrecoverable level. Now, the other example I want to give you is 2022. So back in 2022, this was a trap which the Fed set themselves. So basically, the inflation was skyrocketing, but the Fed has been telling the market that this is a transitory inflation for almost a year, which basically gave a very limited time for the Fed to react to the inflation itself, which ended up lingering in the market for such a long time. So when the Fed gives a wrong message to the market on a very significantly important data, this could lead to a long-lasting fall in the market, just like what happened in 2022. So in order to avoid the 15 to 20% chance of falling into the bull trap, we also need to monitor a few more things. Number one, the ultimate thing that we need to monitor is the credit in the market. What I mean by credit is measured through a thing called a credit spread, i.e. the Bank of America US high yield index spread. Now, what this is the extra premium of the yield which the smaller companies or junk-rated corporations must pay over the US Treasury's risk-free yield to borrow money. For example, if there's a huge company which is making so much money, which doesn't even need to borrow any money, if this company goes to the bank and tries to borrow the money, this company should be able to borrow at a very low rate. However, if there's a small corporation which wants to borrow money, if this company which is not performing that well goes to the bank, this company will have to pay a huge interest rate. Now, the gap between this huge company's interest rate and the small corporation's interest rate, which both of them pay, is the gap which we need to monitor, and that is measured through a thing called a credit spread. Now, generally, this credit spread can go up to almost 8 to 10%. Basically, the small corporations with junk ratings can pay almost 8 to 10% premium versus the risk-free rate. However, when there's a credit crunch, what happens is these junk companies has to pay 15% or 20% premium versus the risk-free rate, which basically means that all these smaller companies are on the verge of going bankrupt because they're being squeezed with the high interest rate. Now, when there's less credit in the market and when the market is suffering from a credit freeze, these companies will not be able to borrow money and all these companies will go bankrupt, which means that there will be a lot more unemployment, which would lead to a less active economic activity, which could lead to a unfavorable macroeconomic data, which could lead to a further drop in the market. So this is a metric that we need to monitor. Now, to give you an example, back in 2020, after the COVID era, when the Fed acted very fast to decrease the interest rate to almost zero and started pouring liquidity into the market, this spread, despite the economic challenge which the whole world was facing, because of so much liquidity in the market, even these junk-rated companies were able to borrow money at a very low rate. So basically, how the Fed acts in response to certain economic challenges that they face could impact the market's liquidity, which could in turn also impact the credit situation in the market. But there are certain circumstances, as I said in my previous examples, where even if the Fed is injecting liquidity and lowering the interest rate, there could be cases where the systemic imbalance is so huge that even the Fed's actions cannot save the market. So those are the situations where we need to look out for by monitoring the credit spreads. And also, the second thing that we need to monitor is the inflation. Now, one thing I'll say is that the 5-metric strategy works when the Fed is actively involved in the market. Basically, the Fed is trying to decrease the interest rate and they're trying to inject as much liquidity as they can into the market. That is the fundamental basis of the market rebounding. If the Fed doesn't do anything, we could go back to the Great Depression era when there was so much deleveraging happening in the market. But if the Fed does nothing, the market will just continue to go down and down and down, leading to a decades of economic depression. So the fundamental assumption here is that Fed is going to be actively involved in the market to save the market's credit. However, when the inflation is high, there's nothing the Fed can do. One example is back in 1973, when the Fed had to just watch the stock market crash almost 50% because of the OPEC oil embargo forced them to prioritize fighting inflation over saving asset prices. Now, under those situations, we need to monitor what the Fed's primary mandate is. As number one, lowering the unemployment rate, and number two, keeping the inflation low. So under a situation when the inflation rate is so high that there's no actions which the Fed can take, this whole model just becomes broken. Now, if we apply that to the current world, basically the CPI on an YY basis is currently at about 3.3%, which is extremely high. Now, that's why I've been telling you that this inflation needs to come down very quickly to below 2.5% in order for the Fed to have a lot more room to take actions when there's a systemic or credit crunch. Now, the third thing that we need to monitor is obviously, as I've mentioned in my previous example, whether there are any fraud in relation to the accounting standards. Now, when there is a distrust of the accounting, which is basically the language of finance, in the accounting from the investors, everything breaks. Now, the contagion of fabricated financial reporting among top-tier publicly traded companies may lead to a catastrophic disposal of all the assets in the stock market, which nobody can stop. Even the Fed, even if they inject liquidity into the market, people may think that the Fed's action of injecting liquidity is also a fraud. So this fine balance of trust between the market and the institutions and the corporates needs to be maintained very clean at all times. Okay, so today I gave you some very simplified version of how to succeed in the market. So those 5 metrics are the primary metrics which I would like you to monitor in order to succeed in investing. But obviously, as I said at the start of the video, please go back and watch my 3 other videos as well very carefully in order to get a better understanding about investing. I hope you enjoyed the video, and I'll be back with more videos very soon. Okay, so that wraps up everything I wanted to cover in this compilation video. As you may have felt from all the videos, there's no single rule to succeed in investing. I sincerely hope you thoroughly watch and study everything I laid out in this video and come up with an investment strategy which would work for you. After all, everyone has different personalities and life principles, which makes it impossible for someone to force a single strategy that would work for everyone. So I just hope this video at least helped everyone watching to some degree, and also thank you guys for watching throughout the long video. I'll be back with more videos very soon.